Good morning, Mr. Fidelis Sabu and Mr. Mahmoud.
Good
Can you
morning,
hear me,
sir.
please?
We can
Yes,
hear you,
sir.
sir. Good morning. Yeah.
Okay. It's already 10:40
Good morning,
a.
sir.
Good morning, madam. So I'll be sharing my screen shortly so that we can start. Then others will join us gradually. So let me know if I'm too slow or if I'm too fast. You can just raise up your hand or call my attention if possible. You understand?
Why? No, one, sir.
Okay. So my name is. Can you hear me, please?
We can hear you, sir.
All right. My name is Isaac Oladokun. I'm an AAT and ACA, one of the tutor that will take you to case study for this diet. So, case study is very simple and straightforward because you already know what they're expecting and there will be a pre-seen question before the exam day. But there are some things. In case study, there is no right answer, there is no wrong answer. Case study is actually an imagined scenario or real life situation that most business school adopt in order to know what is your own view, what's your own perspective. So there are some things expected of you as a finance professional that ICANN is expecting you to know. What are those things? What case study is all about is just the analysis of financial statements. So let's quickly go through this. Then we have some illustration that we're going to do. So, what are the knowledge expected from other courses? You need the knowledge of corporate reporting, especially on ratio analysis. You need the brought forward knowledge from performance management. You need brought forward knowledge of CSME because they are going to test what we call business models. And there are about 20 of them. And you also need the knowledge of report writing. You understand? So, we are going to go through financial statement analysis today. Please, am I audible? Hello, please, can you hear me?
Very, very audible, sir. Very, very audible.
Okay, thank you. Can you see my screen also?
Yeah, I can see your screen now.
Okay, so I'm going to put this on chat section so that everybody can download this material. So let me quickly take us through. When we are talking of financial statement, there are components of financial statement such as content of financial statement of comprehensive income, statement of financial position formerly known as balance sheet, statement of changes in equity, statement of cash flow, note to account and management commentaries. Among these statement of financial position, what are the things they really want you to know that is extremely important for case study as far as ICANN is concerned? You just need analysis of statement of financial position, formerly called balance sheet, and statement of profit or loss and other comprehensive income. Do you understand? Now, objective of financial statement analysis. The objective of financial statement analysis is to draw information which facilitates an evaluation strength and weaknesses of business. Before business is a calculated risk that man engage himself in order to earn a living. What do I mean by calculated risk is the aim of going into business is either to make profit, the aim is to make profit, but in reality, you can make profit, you can make loss, or you can break even. That's what make it that is what make it a calculated risk. Hello, is someone talking? Okay, so that is what makes business a calculated risk because your aim is to make profit, but at the end of the day, you can make profit, it can be loss or break even. So the objective of financial statement analysis is to draw information which will facilitate an evaluation of strengths and weaknesses of the business, whether the business you are going into is it a viable project or not. There are several notes that I will just be touching them small so that we can move very fast because we have illustrations to do. We have about 6 illustrations I'm going to do for us because what I'm taking is basically majorly calculation aspects. You understand? And we're also going to treat Pathfinder together. Now, types of financial statement analysis. We have external analysis, we have internal analysis, we have short-term analysis, we have horizontal analysis, and vertical analysis. This type of financial statement analysis is there for illustration's sake. Nobody will ask you in exam what are the types of financial statement analysis. Rather, they will give you a scenario-based question for you to analyze statement of financial position and statement of profit or loss and other comprehensive income. Also, there will be a proposal. Maybe company intend to they propose certain things. Maybe they want to do a particular project for the next 3 years, maybe supply of so and so. So then you will be then what that scenario require is your brought forward knowledge of something in mathematics. We call it word problem in mathematics. What do I mean by that? You will carefully interpret each of the line one by one. Once you are able to interpret the proposal correctly, you have the knowledge of your business model, then ratio analysis knowledge, and report writing, you are good to go. You understand? So type of financial analysis, we have external analysis. This is analysis carried out by external party to entity, and the entity publish financial statement. Okay, publish financial statement form the basis of this analysis. So in order to be on the same page, I want somebody to read for me the technique of financial statement. I want Mr. Momodu, Madam Momodu to read comparative financial statement, comparative financial statement. I want the next person to read common size financial statement. Can you please go ahead, sir?
Good morning. Comparative financial statements. This involves the comparison of an entity's financial statements over a period of time, say at least over a 2-year period. It compares the entity's income statement and statement of financial position over the period. It provides meaningful information when compared to similar data of prior periods.
Thank you so much. The
You're
next
welcome.
person. So before the next person starts, comparative financial statement, you are comparing historical record, maybe of 2 years in your exam. There will be financial statement of minimum of 2 to 3 years. There is something called precinct question. Those are the questions the icon will send to you before your exam day. And there are some unseen. But you need to be careful. There are some part of financial statement in precinct that you will need for unseen. Meaning, if they want to give you 4 years financial statement analysis, they can give you 3 in pre-seen, 1 in unseen, or give you 1 in unseen, 3 in pre-seen. Meaning, you cannot do without unseen, and you can't do without pre-seen. Two are together. The motive of sending pre-seen question is I can discover that before your exam day, people don't really have much time to read. Before you start reading, before you finish reading, before you start interpreting, and you have only 3 hours, 15 minutes for the exam. Do you understand? So that's why they always send you precinct questions so that you have the idea of what is coming. You are not expected to start reading precinct question on your exam day. Rather, go to unseen. The first thing you do is you first go to the requirements. What are they expecting from you? They will tell you you are senior accountant of, your name is Mr. Laide, a senior accountant of ABC PLC. Your boss is Mr. Olayemi, is the managing partner of XYZ and Co. Maybe you are working an audit firm. One of your clients sent a financials to you. You are expected to analyze that financials. You understand? Your role, they will tell you what your role is, but all those things are just there to tell you what are you picking from there. What is your name? Who are you reporting to? The report you are writing, is it for internal or for external? If it's for internal, you don't need to write disclaimer of opinion. I'm sure the other guy has taken you through how to write report and disclaimer of opinion. So You don't need to write disclaimer of opinion if it is to internal, but if it is external, you have to write disclaimer of opinion. Do you understand? Then the executive summary, I'm sure you are taking care of that. What am I saying is this. First, identify what they are talking about. Why? Because you don't have time. You have only 3 hours, 15 minutes. And out of that 3 hours, 15 minutes, when you start reading, if you really understand what you want to write, you don't have enough time. Do you understand? Because you may want to also display skill that this thing is very simple. It's just a ratio analysis and comparison of ratio analysis, then proposal of the business, report, executive summary that can take up to 12 pages. So what are the strategies I'm expecting you to use? We are going to skip some of these. I will just explain them. You can read it on your own so that we can just go to what ICANN is expecting from you, because we don't also have much time. Today is 24th of February. Your exam is in May, so we have to try as much as possible to move as far as possible, but as fast as possible, but not at the detriment of your understanding. I will slow down to make sure that you comprehend what they are expecting. Now, you have given, she just read to us comparative financial statement. That is basically what you are going to write in the exam. You are comparing financial statement of 2002, 2003, 2004. It may be 3 years, it may be 4 years. That settles. So the next person should read the next one.
Common size statement.
Okay. Go
So
ahead,
I can't
please.
see the screen again. I was reading
Okay, can you
from
see
this.
that?
Yes, sir.
Okay. All right.
This analysis is done by converting the figure of the financial statement to percentages. For the income statement, the figure for revenue is taken at 100%, and the figure of the other items of income statement are expressed as a percentage of the revenue figure. Also, for the statement of financial position, the figure for the total assets taken as 100%, while the other item of the statement of financial position are expressed as a percentage of the total assets.
Thank you. Common size. This is done by converting the figure of financial statement to 100. For example, now you may be asked to find profitability ratio, liquidity ratio. You understand? So profitability ratio, we all know, is what? Profit before interest and tax. You understand? Over what? Well, when we are talking of profitability ratio, we are talking of ROAS, return on capital employed, and profit margin. And when we are talking of profit margin, we also have gross profit margin, we have net profit margin. You understand? So let's assume we are talking of gross profit margin, which is profit over sales times 100 over 1. Your answer will be in percentage form. One thing you also should be extremely careful of is when you are dealing with ratios, especially profitability ratio, your answer must be in percentage form. For example, 3 over 7 times 100 over 1. Everything you are writing should be in percentage. If you don't write percentage, that shows what you've written is not, it doesn't make sense. They won't be able to interpret it because they take cognizance of everything writing. You understand? So techniques for financial analysis, we have comparative financial statement, common size financial statement. Don't worry, I will send this material to you. Statement of working capital ratio, trend analysis. Trend analysis, that's comparison over the period. Ratio analysis, which is where we are going. Type of accounting ratio, coverage ratio, return ratio, turnover ratio, and component percentage. Now, let's go to, okay, that's type of accounting ratio. Okay. There are 5 groups of ratio that can be calculated from income statement and the statement of financial position. This is what I'm talking about. This one. Can you see it, everybody? Hello?
Yeah, we can see, sir. We can see,
So
sir.
we can.
Okay, all right. Thank you.
That's for accounting ratios.
Okay, you can see it clearly now, right?
Yeah, much better.
Okay. So there are 5 group of ratio that can be calculated from income statement and the statement of financial position of a company. This group of ratio measures the operating performance and financial condition of the company. These are number 1, profitability ratio. These ratio are used to assess the what? Level of profitability of business entity in relation to revenue generated and capital invested. What do they mean by that? You invest 1 naira, I told you initially that business is a calculated risk. Your aim is to make profit, but in reality, you can't say business is a risk. Risk is a situation whereby you climb 3-story building and jump down. That one is risk. But when we are saying calculated risk, you are expecting returns. You understand? You are expecting something in return. So it's a calculated risk that you venture into with the aim of making profit. But in reality, you can make profit, loss, or break even. Then there's something called profitability ratio. That one is divided into two categories. Who can help us? We have rules and what? Gross profit margin. I think I mentioned it earlier. I want the next person to read the next one.
Okay, which one am I reading, sir?
Liquidity ratio.
You've gone past there now.
No, here. This one.
Okay. These are ratios that measure the ability of a business entity to meet its short-term obligations. That is, pay its day-to-day debts as they fall due by using assets that can be quickly converted to cash.
Thank you.
This
Now,
okay.
these assets are normally referred to as liquid assets, and they are shown in the statement of financial position as current assets. If you have every business, one way or the other, they borrow money to finance that business, isn't it? If you borrow money to finance the business, and you need to quickly pay back that money, you understand? You borrow 7 billion from bank, and you are paying back in 7 years. An obligation that is due within 1 year is called current asset. The one that is more than 1 year, current liability, sorry. The one that is more than 1 year is called non-current liability. That's why in your statement of financial position, we have, let's even run through that. We have, it's divided into two. We have asset side, we have liability side. Under assets, we have tangible and we have non-current asset. Under non-current asset, we have tangible and intangible. Under intangible, we have goodwill, patent, copyright, trademark, but the popular one is goodwill that is subject to impairment on annual basis. You understand? Then under the excuse me, under the tangible, those are the PPE, the ones you can feel, touch, that is subject to depreciation on annual basis, such as land and building, plant and machinery, motor vehicle. You understand? That covers for assets. Then under liability, then that's for non-current assets. Other current assets, we have what we call receivables, what we are selling on credit, inventory, cash and cash equivalent, bank, prepaid expense. Then under current liability, we have what we call tax due within 1 year, accrued expenses, current liability. What make current liability current liability? They are obligations that are due within a year or within an operating cycle of the business. An annual operating cycle of the business. You understand? That is current liability. Now, so your ability of assets to cover your current obligations as when due is part of what we call liquidity ratio. This asset normally referred to as liquid asset as they are shown in statement of financial position as current asset. Next person, read the efficiency ratio. Hello, can somebody read the efficiency ratio for us?
Efficiency/activity ratio.
Thank
These
you.
ratios measure how efficient the business entity has been utilizing its assets.
Thank you. It measures how efficient the business entity has been utilizing its assets. You understand? So, what of long-term solvency and leverage ratio? This ratio shows the capital structure of a business. It shows the mixture of the business capital between equity, proprietary capital, debt, and long-term liability. They provide information on degree of company's fixed financing obligation and its ability to satisfy these obligations. Now, all these ones are for you to have the idea, to remind you, to refresh your memory of ratio analysis. Nobody will ask you to define profitability ratio ridiculous. No, rather you'll be asked to calculate, which is where we are now going next. Then, meaning we have 5 categories of ratio, remember. profitability ratio, liquidity ratio, efficiency/activity ratio, long-term solvency ratio, and investment ratio. Meaning, in your exam, you may be given a scenario whereby you're asked to calculate all the relevant ratios. So you should know that we have 5 categories. Profitability ratio. And when you are saying profitability ratio, these are the things that should come to your mind: return on capital employed and profit margin. You understand? That's for profitability ratio. When you are saying liquidity ratio, the first thing that should come to your mind is what? Current ratio. And when we are saying current ratio, we are moving there to those calculations gradually. But I just want you to have the idea before we move to the calculation aspect. All right. So we have 5 categories of ratio: profitability, liquidity, efficiency, long-term solvency, and investment ratio. Now, this is what exam we ask you. ICANN will ask you. Profitability ratio. How do you measure profitability ratio? Can somebody read this formula for me? Return on capital employed.
Return on capital employed equal to.
Yes.
So what's the
Equal
meaning
to,
of the EBIT?
okay,
Equity
it's the same
before
thing like
interest.
EBITDA. EBITDA, that's earning before interest and tax, depreciation and amortization. You understand? So return on capital employed is EBITDA divided by net assets. What do we mean by net assets? Total asset less current liability. Note, it is total asset less current liability only, not total liability. Because when we are talking of liability, we have current and non-current. Do you understand? So it's total asset, EBITDA, that's earning before interest. That's why they also call it profit before interest and tax. It's the same thing as earning before interest and tax. So in a situation whereby I can give you a financial statement, the calculated profit after tax, interest, you understand? What you must do is for you to calculate the return on capital employed, if they have deducted interest, you have to add it back. It is any before interest and tax, because they can give you any before tax. You understand? But interest has been deducted before they arrive at that. So you must know that it is any before interest and tax divided by total asset less current liability. That's for return on capital employed. The other interpretation is this: any before interest and tax, shareholders' equity plus long-term liability. This one and this one, they are the same thing. You understand? Because in the statement of financial position, asset is equals to what? Equity plus liability. You understand? Now, return on equity in its variation rose, but it concentrates on entities equity holder, and compare the equity capital with the amount of profits which can be attributable to them. The ratio is calculated as follows: the return on equity is net income over average total equity. That is average total shares. This return on equity is very rare, but they can also ask, so you need to know it. Net income means any before interest and tax over average total equity. Then gross profit margin and net profit margin. Remember, we are still talking on profitability ratio. Meaning, if you ask to calculate profitability ratio, let me go back again. If you ask to calculate all the relevant ratio, the 5 ratio must come to your mind: profitability ratio, liquidity ratio, efficiency ratio, long-term solvency ratio, and investment ratio. Then, when you are calculating that of profitability ratio, the first two that must come to your mind is return on capital employed and gross profit and net profit. Can somebody read gross profit margin for us and another person net profit margin?
Gross
Gross
profit.
profit margin. Okay.
Okay.
This ratio expresses the entity gross profit as a percentage of sales revenue and is also known as gross profit percentage. It is simply calculated as follows: gross profit all over net sales multiplied by 100.
Thank you. Now, gross profit over net sales. What do they mean by net sales? Is total revenue less return inward. For example, you buy something from a company, and part of those products, you need to return them back to the company. You understand? So definitely the company will issue you credit notes, meaning they are reducing the liability you are owing them, provided you buy on credit. You understand? Or they give you credit notes so that you can use it to offset the subsequent purchase from them if you decide to patronize them, or they refund you. That's what they mean by net sales. So it's actually gross profit over sales times 100 over 1. Next person.
Net profit margin. It
Yes.
expresses the entity's net profit as a percentage of sales revenue. It is
Thank you.
calculated as
Continue.
net income all over net sales times 100.
Over 1. Excellent. Now, so I believe that one is very straightforward. So anything you get, it has to be in 100. It has to be in percentage. Then current liquidity ratio. Liquidity ratio, under liquidity ratio, we have current ratio, we have quick ratio, we have absolute liquid ratio. You understand? Yeah. Now, current ratio, quick ratio, absolute operating cycle of the business. Yeah. Before we move to efficiency ratio. Now, under liquidity ratio, it's just current assets over current liability. You understand? That's for current ratio. You know what are the components of current assets? You know that already. You understand? Receivable, cash, bank, current liability, payable, accrued expenses, or tax obligation that is due within a year. That forms your current ratio. Then quick ratio. Don't worry, I'm going to send you this material, so you will read it over again. How will you be able to meet up your obligation without your inventory? That is what quick ratio is speaking to. That's why the formula is current asset minus inventory over current liability. You get? Then absolute liquid ratio. This one they hardly ask, but it's here for illustration's sake. Absolute liquid ratio is cash plus marketable security divided by current liability. So, but most important is you must put in your mind when you are asked to do liquid ratio are number 1, current ratio and quick ratio, followed by operating cycle of the business, cash operating cycle of the business. Can somebody please read this for us? Operating cycle. Who has not spoken among 3? I think, who is the person? Okay. Can somebody please read this to us, please?
We can see it.
The cash operating cycle. Yeah.
Operating cycle. A company's operating cycle is the time it takes the company to convert its investment in inventory back into cash. It is considered the number of days the company ties down cash invested in inventory before the cash is realized after collection of receivables. The operating cycle of a company that manufactures and sells goods compasses of 4 phases as follows. Raw materials are purchased and goods are produced and kept in inventory. Goods are sold from inventory to generate sales revenue, which may be on credit, in cash or both. Third, extend credit to its customers, which leads to account receivable, and puts on account receivable are collected to generate cash. The cash.
It's fine. It's lots of time. All right. So for operating cycle, okay. The cash operating cycle, it just has to do with the capital you put in business. How long will it take you to recover your capital back? That's why the formula is cash operating cycle days equals to inventory days plus receivable days minus payable days. You understand? Inventory days, we are going to calculate that one shortly. Receivable days minus payable days. You know, it just, these are current asset days minus current asset days, liability days. It's as simple as that. How do you calculate your inventory days. Average inventory divided by cost of sales times 365 days. But there might be an assumption in your exam that you should assume 360 days. You must abide by the instruction of ICANN. They're asking you to use 360 days. Then that's for how do you calculate average inventory? Opening inventory plus closing inventory divided by 2 gives you average inventory. You understand? Also, for accounting receivable days, average accounting receivables, anything average, it means if it is 3, you have to add the 3 together and divide it by 3. If it is 2, add the 2 together and divide it by 2. If it is just 1, because they may give you closing inventory only, that shows you are restricted to only closing inventory. Do you understand? All right. So average inventory over cost of sales times 365 days. For accounting receivable, average accounting receivables over revenue times 365 days. Then for payable, average accounting payable divided by cost of sales times 365 days. In a situation whereby you don't have cost of sales, you use what we call purchases. Therefore, the net operating cycle is number of days of inventory plus number of days of receivable minus number of days of payable. It's as simple as that. So the next one we are going through is efficiency ratio. There's something called asset turnover ratio, which is sales over average total assets. Then the other one, inventory turnover ratio, cost of sales over average inventory, receivable turnover ratio, credit sales over average receivables, and so capital gearing too. In capital gearing, is just preference share plus non-current liability over is always debt, and debt, the one they normally test most things, debt equity ratio. Okay.
So at the capital gearing, is it under efficiency ratio?
Yeah, it's not that long-term
Solvency
solvency
ratio.
ratio. Thank you.
Okay.
Yes. You understand? It's not that long-term solvency ratio, which is the same thing as efficiency slash activity. I mentioned the efficiency slash activity ratio. So under efficiency slash activity ratio, we have capital gearing. Let me see. Let's go back to our illustration. We have efficiency ratio with treated. So it's not that long-term solvency ratio that we have gearing. Okay. These ones are under efficiency slash activity ratio. Then all these ones are under long-term solvency slash leverage ratio, capital gearing, and then debt equity ratio. Then interest cover, that's profit before interest and tax over interest payable. Then investment ratio, which is the last one. The main investment ratio are EPS, that's earning per share, net income minus preferred dividend over weighted average share outstanding. What is preferred dividend? These are the dividend that are entitled, then shareholders that are entitled to fixed rate of dividend. They are called preference shareholders. So once the company make profits, they quickly get their fixed percentage. You understand? So net income minus preference shareholder over minus preference dividend divided by weighted average share outstanding. Then the next one is price earning ratio. All these ones are under investment ratio. That's market share price divided by what? Earning per shares. So the strategy you are going to adopt for this, then we have dividend covered. Dividend cover has to do with all your profit you are making. How net profit after tax and preferred dividend divided by dividend payout. You pay certain dividend payout. How many were you able to cover? You understand? So your dividend cover will be in form of times. You are able to cover so period, maybe 600 divided by 5 divided by 100. That's 6 times. That's how you were able to cover your dividend for that period. We are going to treat Pathfinder to explain everything further so that you will even see what exam looks like, but it's not today. That would be, I think, third lecture. But today we are still going to do some other dividend yield, then financial statement analysis and case study. Then the next one we are going to do, all these ones are for illustration's sake. Can read them more because we have okay, exam for financial data analysis, financial forecasting. They are still speaking to the same thing, budgeting. Now, financial appraisal and reporting. That's where we are going next. Under financial appraisal, there's something called cost volume profit analysis. It shows how costs. This shows how cost and profits change with the changes in volume of activities. Cost volume profit analysis is an application of marginal costing concept. Who can tell me? Hello? Who can tell me
Okay.
what are the component of prime cost? What is variable cost? Who can help us? There's something called prime cost. I'm sure you must have done it maybe in skill level or when you were in school. Can you still remember? Who can help us out? Please feel free to interrupt me
So
anytime. You understand?
are you asking for prime cost or variable cost?
Both. The one you can tell us, just tell us.
Okay, sir. I think prime costs, they are direct costs of commodities or
Excellent.
materials. And
Excellent. So the component are what?
the components like fixed costs, excluding
At least you have an idea. It's fine. It's
Direct
okay.
labor, direct expenses,
Clap
direct
for yourself.
materials.
Clap for yourself. Clap for yourself. So the component of prime cost are direct material, direct labor, and direct expenses. You understand? That's component of prime cost. Now, when we are talking of variable costs are costs that vary with the level of output. Meaning, as output changes, the variable costs change. You understand? So there are some assumptions on cost volume profit analysis. These assumptions, nobody will ask you assumption of this in exam. Rather, they will give you a life scenario. So let's go to illustration 1 on this. Can somebody read this illustration 1 for us?
A company makes and sells a single product. The product has a
Oh,
variable product.
sorry for cutting you short. Sorry. Let
Okay,
me
sir.
quickly, so that you will understand what we are doing. Let me quickly run us through these assumptions. Assumption in cost volume profit analysis. Costs are either fixed or variable. It means the variable cost per unit is the same at all levels. It's just an assumption. Meaning for us to work this thing, we must assume some things. Fixed costs are normally assumed to remain unchanged at all levels of output, meaning fixed will remain constant. Contribution per unit is constant for each unit sold. It's also an assumption that if contribution per unit is constant for each unit sold, then our illustration 1 calculation will be meaningful. If we assume that the sales price per unit is constant for every unit of product sold, that's what in economics language they call it ceteris paribus, all things being equal. Sales price per unit is constant for every unit of product sold. Therefore, the contribution to sales ratio is also a constant value at all level of sales. If sales price per unit, variable cost per unit, and fixed costs are not affected by volume of activities, sales and profit are maximized by maximizing total contributions. What are they saying? That sales and profit are only maximized by what? If you maximize your total contribution. Okay, back to what you are reading. Oh, yeah, read for us.
A company makes and sells a single product. The product has a variable production cost of 8 naira per unit and a variable selling cost of 1 naira per unit. Total fixed cost, That's production, administration, and sales and distribution fixed costs are expected to be 500,000. The selling price of the product is 16 naira. The profit at sales volume of 70,000, 8,000, and 9, okay,
Thank you.
70,000, 80,000, and 90,000 units can be calculated as follows.
Thank you so much. Now, I want somebody to say, let me give you guys my phone number now. Say hi to me. I'm going to send you the material so that we can be on the same page. You understand? My phone number is zero is okay. I should be able to let me check. I should be able to share this, share the material with you guys on
Are you
this.
not in the group?
Yeah, I want. Okay, let me put the material on the chat
Yes, sir.
so that we can all access it. Okay. Mhm. Okay, so you will get it now so that you can just download it and then. Okay, so you can check the chat box now for the two materials we are using. So illustration one. So when you download the first one, you go to page 16. So we do them one after the other. A company makes and sells single product. Product has a variable cost of 8 naira per unit and variable selling price is what? 1 naira. Now, what does that one speak to us about? He said 8 naira per unit. That's the product has a variable production cost of 8 naira per unit. Variable selling cost of 1 naira per unit. How many variable costs do we have there? Hello?
We can't see your screen. We are just seeing just your name.
Okay. The material is there. Please download it. Check the chat box. You can download the two material. Then go to page 16. So how many variable costs do we have there, please? Amaka, are you there?
Yes, sir. We have two variable costs.
Thank you. Which are what?
Um,
How much is the first one?
the production cost and the selling cost
Production cost, how much?
of 8 naira per unit.
Okay. Selling cost, how much? 1 naira
1
per
naira
unit.
per unit.
So
Yes,
we
sir.
have ascertained that variable costs are what? In total, they are 9 naira, right?
Yes,
Then
sir.
we have constant fixed cost of what? 500,000. The selling price of the product is 16 naira. Profit at sales volume. So our sales volume are in three: 70,000 units, 80,000 units, and 90,000 units. Are you with me?
Yes, sir.
Okay. All right. So let's go to the solution now. I sent you two material, right?
Yes,
So
sir.
you can
Yes, sir.
download the second one also. That one is about 4 pages. A company makes and sells a single product. The product has a variable cost of 8 naira per unit and variable selling cost of 1 naira per unit. Total fixed cost, that's production, administration, and selling. Total fixed cost is 500,000. The rest are stories. The selling price, can you see my screen, please? Oops.
Just your name that is
No,
showing.
sir, we can't see your screen.
Okay. Let me share it. Oh, sorry. Can you see it now, please?
Yes, yes.
Yes, sir, we can.
Okay, this is the first illustration we are creating. A company makes and sells a single product. Product has a variable production cost of 8 naira per unit. Selling cost is 1 naira. Total fixed cost is 500,000. Selling price of the product is 16. Then the profit at the sales volume of 70,000, 80,000, 90,000 can be calculated as follows. So this is the solution. What's the first thing you do? You arrange them 70,000, 80,000, 90,000. What is sales revenue? Sales revenue is, according to this, can say selling price of the product is 16 naira. So if you are with calculator, somebody should calculate 16 naira times 70,000. Another person 16 naira times 80,000. Another person 16 naira times 90,000. Once you get it, unmute your mic and tell us.
16 times 70,000 will give us 1,120,000.
So that is where this one is coming from. Another person, please.
The second one, 1,280,000.
Thank you. That's where this one is coming from. Another person.
1,440,000. 16 times
Okay.
90,000.
Thank you. That is where our. So what are the things? What's the first step you calculate? What is the first thing you do? You calculate what we call sales value first. How do you calculate sales value? They've given you the selling price. You have the volume already. So what you just need to do is to multiply each of the volume by 16 naira. Now, the next stage is variable costs. According to this question, you have two variable costs there, 8 naira and 1 naira. That gives us what? 9 naira. So as variable cost is what? 9 naira. I want one person, the first person to calculate 9 naira times 70, another person 9 naira times 80, another person 9 naira times 90.
Six 30, 9 naira times 70. 630,000.
Okay. Another person. So that's where that 6,630 is coming from. Another person, please.
720,000. 9 naira times 80.
Okay. Another person.
9 times 90,000. 810,000. 9 naira times 90,000.
Thank you. So revenue less variable cost. I mentioned prime cost last time. Prime cost is total variable cost. But in exam, they can give you prime cost. They can give you combination of all the prime costs. You know what happened here? They wrote variable production cost, variable selling price. They are all variable. And prime cost divided into what we call direct material, direct labor, direct expenses. You understand? So for variable cost, we have 9 naira. 9 naira times 70, 9 naira times this. So selling price minus variable cost will give you contribution. Do you understand? So the first one, if you deduct 630 from 1,120,000, we give you 490. Do you understand? Now, that is variable cost, that's contribution in value. What of contribution per unit? How do you get contribution per unit? 16 naira minus 9 naira will give you 7 naira. That is contribution per unit. Back to the question. How much is our total fixed cost? 500. Fixed cost is the cost that does not vary with the level of output, meaning it remains constant across the board. You have 500,000, 500,000, 500,000. So profit or loss will be what? For the first one will be negative 10,000. Second one will be 60,000, and the third one will be 130,000 positive. Hello. Do you understand
I'm
where
with you,
that is
sir.
from? Okay, is it clear now?
Yes, sir.
Please, if you have any question before we proceed, I I told you that you can um you can always interrupt anytime. You understand? So if you have any question, let us know. All right. So let's go to the second illustration. I'm sorry. Illustration 2. Now, break-even analysis. Because volume profit analysis can be used to calculate a break-even point for sales. So break-even point is the volume of sales required in a period such as financial year to break even, and it makes neither profit nor loss. As break-even point of zero, manager might want to know what the break-even point is. What does break-even point represent? When company make neither profit nor loss, we call it break-even. How do we calculate break-even? Total fixed cost divided by contribution per unit. That is, if you are asked to calculate break-even point in sales unit. Are you with me? So, if you are asked to calculate break-even point in sales value, there are two ways to go about it. Hello, Amaka, can you hear me?
Yes, sir. We can hear you, sir.
Okay, what of the other man? I think you guys are four.
I'm here, sir.
Yeah,
Okay. I think remaining is third person.
someone left. I think she left.
Oh, okay.
Maybe her network or something.
Okay. So break-even point in sales unit, we have total fixed cost divided by contribution per unit. That's for break-even point in sales unit. Also, to calculate break-even point in revenue, very simple. Everything you've gotten in this sales unit, multiply it by selling price, or say fixed cost divided by contribution to ratio. How do we mean? Look at this. My brother, read the second illustration for us, illustration 2.
Okay, sir. Second illustration, yeah.
Yep.
A company makes a single product that has a variable cost of sales of 12 naira and a selling price of 20 naira per unit.
Okay, continue.
Yeah. Budgeted fixed cost are 600,000. What volume of
Okay,
sales is required to break even?
thank
Method
you.
1. Okay, sir.
Yeah. So there are several methods of doing this, but the easiest one is if you are given this kind of scenario, what is the method for breaking even? It will be total fixed cost divided by what? Contribution per unit. How do you get contribution per unit? Selling price, which is 20 naira, minus variable cost, which is 12 naira. We give you what? Contribution. You know, I told you how to calculate contribution per unit before now. So this is it. Selling price per unit is 12 naira. It's 20 naira. Variable cost per unit is 12 naira, which it gives you what? As contribution per unit. So your break-even point will be 600,000 naira divided by 8 naira. At the end of the day, naira will cancel naira. Yes or no? Hello? Amaka, are you with me?
I'm with you, sir.
Okay. So at the end of the day, naira will cancel naira. So it should be 600,000 naira divided by 8 naira. So naira cancel naira. 600,000 divided by 8 will give you 75,000 units of sales. So the unit of sales will be what? 75,000. So What volume of sales is required to break even? That's for unit. But in sales value, it will be 75,000 naira times 20, 20 naira will give you 1.5. Another way of doing this is, they wrote something like this. If you check this illustration, they wrote break-even point in sales value, fixed cost divided by contribution sales ratio. Another contribution sales ratio is, what's your contribution? What's your break-even? Fixed cost divided by contribution sales ratio. Your fixed cost is how much? 600,000. Contribution sales ratio is the same thing as what? 8 naira divided by 20. Amaka, I want you to do something for me. Let me do something.
Okay, sir.
Can you all see my screen?
Yes, sir, we can.
The Excel stuff I just opened.
Yes, sir.
Okay. So 600,000 is the fixed cost. All right. So contribution sales ratio. Selling price is how much?
20 naira.
20 naira. Variable cost is how much? How much is variable cost? I think variable cost is 8 naira. It's 12 naira. You understand? That is, our contribution is 8 naira. So contribution sales ratio will be, fixed cost divided by contribution sales ratio will be 600,000. Contribution sales means 8 divided by 20 is equals to, because contribution sales is equals to 8 this contribution divided by sales. That is contribution sales ratio, which is 0.4. Now our fixed cost is 600,000. 600,000 divided by 0.4 again. 1.5 million. Now let's go back to where we were before. This one they just did it as 75,000 times 20. That gives us 1.5 million. Are we good? Then you can also do it this way. 600,000 divided by contribution sales ratio. What is contribution per unit? What is 6 naira per unit? That's 8 divided by 20 first. We give you your contribution sales ratio, which is 0.4. 600,000 divided by 0.4. What do you have? I want you to quickly do that. What's your answer?
1,500,000.
1.5 million, meaning you can do it two ways. All right. Okay, let's go to the third illustration. But before we go there, let's read. There's something called margin of safety. It's just the difference between budgeted sales and break-even sales. That's all. Margin of safety is the difference between budgeted sales, maybe in unit or naira, and what break-even sales, be it in naira or unit. You understand? It is usually expressed as a percentage of budgeted sales. However, it may also be measured as a quantity of unit, the difference between the budgeted sales volume and break-even sales volume. An amount of sales revenue is equal to the difference between budgeted sales revenue and the total sales revenue required to break even. It is called the margin of safety because it is the maximum amount by which actual sales can be lower than budgeted sales without incurring a loss for the period. A higher margin of safety therefore indicates a low risk of making a loss. All right. Now back to question. Illustration 3. Can you do hello, Mr. What's your name again?
My
Mr.
name is
Fidelis,
Abu.
Abi?
Yes.
Okay, sir. Amaka, I want two of you to do this illustration 3. Don't look at the solution. No. Okay, this is it. Look at the screen. Can you do it for 2 minutes? Once you are done, just tell me you are done. The company budget to sell 25,000 units of its product has a selling price of 16 naira, variable cost of 4. Fixed cost for the period are expected to be 240. Calculate margin of safety.
So margin of safety, is it the same as the break-even point?
No, margin of safety is budgeted sales minus break-even sales. Meaning you have your budgeted sales as 25,000, but you need to calculate your break-even sales in units. Don't let me tell you the answer
Okay, sir.
because it's classwork. Yeah.
Sir, excuse me, sir.
Yep.
This
Are you done?
margin of safety, is it supposed to be in units?
Yes, because a company budgeted to sell 25,000 units. You understand?
Yes, sir. So I'm
So it will
getting
be
0 point something.
0 point something. We are going to do it together now.
0.139. Let me try.
60 units, sir. 60,000 units.
Huh?
60,000 units.
6,000.
60,000 units.
Let's do it together. Now, let's now. Can you see my screen?
Yes, you can see your screen.
Okay. Can you see it now? A company budget to sell 25,000 units, right? Of the product. That should have gotten your budgeted sales already. The selling price is 16 naira. Variable cost is 4 naira. Selling price minus variable cost will give you contribution. Do you agree?
Yes.
It will give you contribution per unit. Fixed cost for the period is 240,000. Do you agree? According to the question. Now, the break-even point is fixed cost. Remember, fixed cost divided by contribution per unit. Let's go back to break-even point formula. This is it. You see it. Total fixed cost divided by contribution per unit. Right? And to get contribution, we have to minus variable cost from what? Selling price. So fixed cost for the period is 240. So it will be 240 divided by 16 minus 4, 20,000. You understand? Amaka? Is it clear now?
No, sir.
Hello, Amaka, is it clear now?
Take it again.
No, sir. So I didn't really understand what you did.
Okay, let's go back. Oh, yeah, read the question. Can you see my screen?
Yeah, we can see, sir.
Oh, yeah, read it for me. Read the question 3 for me.
A company budgets to sell 25,000 units of its product. This has a selling price of 16 naira and a variable cost of 4 naira. Fixed costs for the period are expected to be 240,000. The break-even point, I think that's the solution there.
Thank you. Continue.
Okay, the break-even point is equal to 240,000
Oh, so this
into
one is
16.
fixed cost, right?
Okay, that's fixed cost. Okay.
Divided by
Divide
what?
by, so is it division?
Is division, yes.
Yeah, divide by 16 minus 4 equals to
What
20,000
is
units.
16? That's break-even point in sales is what? Total fixed cost divided by what?
Contribution per
16.
unit.
Okay, contribution, Abi. How do you get contribution? Hello, can you hear me?
Yeah, I can hear you.
So how do we get
The
contribution?
selling cost minus variable cost.
Excellent. You understand?
Yes, sir.
Oh yeah, press your calculator. Selling point cost minus variable cost. How much is that?
That's 12.
It's
Thank
12
you.
naira.
Okay.
12, sir.
So then press your calculator. 240 naira, 240,000 naira divided by 12 naira.
That's
Sir,
20.
are we,
20
excuse
20,000
me,
units.
sir.
Yes, I'm with you.
Sir, are we dividing contribution per unit?
I'm with you.
Sir, I'm confused, right? I thought we are dividing the are we even dividing? You said is the contribution per unit.
Yes. How do you get contribution per unit?
So, sir,
Let's
this
take it easy.
16. Hello, sir.
Yeah, I'm with you.
So, the
Divided by
16
sales
naira
per unit.
here.
Can
Amaka, are you saying
What did you
something?
say? Wait, Amaka is saying something. What do you say?
So I was saying that we were able to get our units right
Mm-hmm.
by doing the 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 contribution
How do you get
naira.
contribution? How do you get contribution?
Contribution is 16 minus 4 will give us 12 naira.
Thank you. So, oh yeah, let's go to back to the formula. So, break-even point in sales value is how much? What's this? Read this. Hello, Amaka.
Sir,
So, how much is this?
is total
Yeah, I mean,
fixed
what is this?
cost.
Total fixed cost over
Yes, sir.
what?
Contribution per unit.
Thank you. So, let's go back to the question. How much is your total fixed cost?
Total fixed cost is 240,000.
Okay. The one you just calculated for us now, how much is it?
12 naira.
Oh yeah, divide it. 240,000 divided by 12 naira. What do you have?
Sir, to get the contribution per unit, I thought we were going to multiply the 12 naira by the 20 naira, which is the unit we are selling, to get the contribution per unit. Because we are doing fixed cost now all over the contribution naira, not the contribution unit.
Don't confuse it though. Contribution per unit is selling price. Write this one down, two of you. Contribution per unit equals to selling price per unit minus variable cost per unit. Nothing more, nothing less. Contribution per unit equals to selling price per unit minus variable cost per unit. Nothing more, nothing less. Do you get it?
I think that's quite clear from my end.
Okay, it's very clear now, Abi.
Yeah, from my end.
Okay, what of I want Amaka to get it before we proceed. Hello, Amaka. Hello. Can you hear me, Amaka? You are muted. I can't hear you. Mr. Abu.
Hello, sir.
Okay, can you hear me? Okay. I
Yeah, I
want
can
to
hear you.
confirm. Amaka can't hear me.
She muted herself.
I'm trying to reach her. Amaka, can you hear us? Hello, Amaka. We can't hear her. I don't know why. Do you get it now?
You mean me?
No. I'm talking about. Do you have a number? Can you call her to talk?
Okay, let
Because
me
I
call
don't
her.
know why she. Okay, you've called her already. So that we can move on because we have about 30 minutes to go.
She's not picking up. Oh.
Oh,
Hello, sir. She's not
maybe
picking up.
maybe she's not with her. Do you have an? Oh, okay. Maybe she
I
excused
just called her
herself.
number now.
Maybe she excused herself. She will join us later. Okay, so you understand, right?
Yes, sir.
Okay, let's go to illustration 4. A company makes and sells a product that has a variable cost of 5 naira per unit and sells for 9 naira. Budgeted fixed cost is 600,000 for the year. Company wishes to make profit of at least 100,000. The sales volume required to achieve this target profit. This one is another example entirely. So we are going to go there also. Target profit. This is the formula. Total fixed cost plus target profit divided by contribution per unit. But I'm wondering why Amaka is not talking.
Or is there anything that happened to our device?
And that's what. Can you give me a? Let me have a number. What's our number?
Okay, can I call it for you now? 081
Please go ahead. Okay.
081
Okay.
60
What do you say?
60
Okay.
42 10 12.
42,
Yes.
10, 12,
12. Yes, that's all.
081 6042 10 12.
Mm.
Maybe she's not in the right position. Maybe she went to use restroom or something. Hello, Amaka. Yeah, we've been trying to. I've been asking you questions on platform. Okay. Just respond to us. Okay. Uh, Okay, Amaka, sorry, we were just wondering. No problem, we understand.
I'm sorry, sir, please.
No problem. All right, so how is work?
It's going well, sir.
Okay, quick one. So, I want you to understand that number three before we move on. So, as I said earlier, I said to get contribution per unit, it is selling price per unit minus variable cost per unit. You have gotten contribution per unit like that. You understand? Are you with me?
Yes, I'm with you.
Okay.
Maybe I'll go
Now,
back to it again on
okay.
my
So
own, sir. Yeah.
no. Let's go through it together.
Okay.
A company budget to make, okay, first and foremost, let's go through this break-even thing one by one. The break-even point in sales units is total fixed cost divided by contribution per unit. Total fixed cost, that one is general. Now, to get the contribution will be selling price per unit minus variable cost per unit. Do you understand? Hello?
Yes, sir. Yes, sir. I'm with you. I understand.
Okay. So, and then fixed cost has been given already. The fixed cost is 240,000 naira. You understand? So, back to this formula, that should we have the fixed cost of 240,000 divided by contribution 16 minus 4, which is 12. So 240,000 naira divided by 12 naira. What will that give us? It's going to give us 20,000 naira. You understand? That is, we have gotten break even point in units, 20,000 naira. Do we need to get break even point in value? Let's check. A company budget to sell and make 25,000 units. That shows what we are comparing 20,000 units with is actually in units. So we don't need to translate it to value. So it will be 25,000 units minus 20,000 units. Do you understand?
Yes, sir.
So margin of safety is budgeted sales minus break-even sales, which is
Yes.
5,000.
All right, sir.
All right.
Thank you, sir.
Yes, ma'am. Then let's go to the next one. Don't worry, in the next 29 minutes we are done. A company makes and sells a product that has a variable cost of 5 naira per unit and sells for how much? 9 naira. No, before this illustration, what are they saying? You may also be asked to calculate target profit. What's the formula for calculating volume that has target profit? Total fixed cost plus target for profit divided by contribution per unit. That's the only difference between this one and what we have been doing. Total fixed cost plus target profit divided by contribution per unit. If it's in unit and they ask you to calculate the revenue, just multiply it by selling price. That's all. Let's go to illustration 4. I'll go through it myself. A company makes and sells a product that has a variable cost of 5 naira and selling price of 9 naira per unit. So, Mr. Abu, what is contribution in this scenario? Contribution per unit. Hello, Mr. Abu. Hello. Amaka, can you hear me?
Yes, I can hear you, sir.
Okay, your other colleague. Hello, Mr. Abu, can you hear us?
I'm here, sir. Just a bit distracted, but I'm with you, sir. I'm at
Oh,
work,
sorry.
but I'm with you, sir.
Okay, you are at work, Abi. Sorry about that. Don't worry, we're almost done. Now, a company makes and sell a product, variable cost is 5 naira, selling price is 9 naira. What is contribution per unit? Can you tell us contribution per unit in this scenario? Okay, Amaka, can you please tell us what's the contribution per unit in this scenario?
Okay, so let me do the calculation. Contribution.
You have variable cost, you have selling price. So the contribution per unit will be how much?
The fixed cost.
No. I'm not saying calculate break even. No, just I want to take it one step after the other. The contribution first. You have variable cost per unit. You have selling price per
4
unit.
naira.
Is how much?
The contribution is 4 naira.
Yeah, contribution per unit is 1 naira. Very good. Now, budgeted fixed cost is 600. The company target profit is 100,000. And the formula tells us that total fixed cost plus target profit divided by contribution per unit. So what are we going to do next? Total fixed cost is 600. Target profit is 100. That's 600 plus 100. That's 700. Divided by 4. You understand?
Yes, sir.
700,000 naira divided by 4 naira will give us how much? 175,000 naira.
Yes, sir.
Okay. All right. So the revenue. So to get there, therefore the sales revenue required to achieve the target profit will be what? 175,000 naira. I mean, 175,000 units times
And
9 naira.
sales price.
You understand?
Yes, sir.
Thank you. That shows you've gotten that one right. Okay. Illustration 5. Can you do? Okay, let's. Can you read illustration 5 and 6? Okay. Illustration 5 and illustration 6. Okay. Let's see if we can meet up. Please read illustration 5 for us.
Illustration 5. The company
Yeah.
makes a single product that it sells at 80 naira per unit. The
Yeah.
total fixed cost are 360,000 naira for the period, and the contribution over sales ratio is 60 naira,
Mm-hmm.
60%.
Yeah.
Budgeted production and sales for the period is 8,000 units. Required, calculate the margin of safety for the period as percentage of the budgeted sales.
What do you think is the first thing we would do? A company make a single product. He said the product for how much? 8 naira.
For
You
18,
understand?
18 naira.
18 naira, thank you. Total fixed cost is 360 for the period. And contribution to sales ratio is 60%. What are they telling us is that the contribution will be what? 60% of what? Selling price. Now, what is 60% of 18 naira?
48 naira.
Thank you. You already know what your fixed cost is. So calculate what's your break-even point. If your contribution per unit is 48 naira, fixed cost is 360. What is your break-even point?
360 divided by 48.
And that is how much?
7,500.
Excellent. Now, 7,500. Budgeted production and sales for the period is 8,000 units, right?
Yes, sir.
So 8,000 units minus 7,005. What do you have?
500.
500. That is your what? Margin of safety. Now, calculate margin of safety for the period as a percentage of budgeted sales. Your budgeted sales is actually 8,000. And when you have to calculate something as a percentage of something, it will be 500 units divided by 8,000 times 100 over 1. You understand?
Yes, sir.
So that will give us 6.25. Is that clear?
Yes, sir, it is.
Okay. Now the final one. I want to reach Mr. Abu. I don't know where he's not. Hello, Mr. Abu, are you with us?
I'm here, sir. Just doing work and listening at the same time. So my attention is
Oh,
kind of
I
divided.
get.
But
I
I'm following
understand. I
up.
understand.
Yeah, I'm following
Oh,
up.
okay. No problem, sir. No problem, sir. Amaka, can you please read illustration 6 for us?
Okay, so illustration 6. A company makes and sells a single product. The following data relates to the current year's budget. Sales and production units, 8,000. Variable cost per unit, 20 naira. Fixed cost per unit, 25 naira. Contribution over sales ratio, 60%. The selling price next year will be 6% higher than the price in the current year budget, and the available cost per unit will be 5% higher than the current year budget. Budgeted fixed cost next year will be 10% higher than the budgeted fixed cost in the current year. Required. For the current year, calculate the budgeted contribution per unit, the budgeted total profit. For the next year, calculate the number of units that will have to be sold in order to achieve a total profit that is equal to the budgeted profit in the current year.
This is the more complex one, but we'll make it simple. Sales and production volume is 8,000. Abi, variable cost is 20 naira. Fixed cost is 25. Contribution to sales ratio is 60%, right? Is that what they wrote? Amaka?
Yes, our contribution to sales ratio 60%.
60%, thank you. That shows variable cost to sales ratio will be 40%. Do you agree?
Yes, sir.
If contribution to sales ratio is 60%, variable
Yeah,
cost to sales ratio will be 40%.
with 40%. Okay.
That shows this 20 actually represents 40% of something. You understand?
Okay,
40% of sales is equal to 20. How do we get sales? So press your calculator. 20 divided by 0.4. What do you have?
20 divided by 0.4, 50.
Thank you. That is where this sales is coming from. That is where this 50 is coming from. Can you see it?
Yes, sir.
Contribution to sales ratio is this. Therefore, variable cost to sales ratio is 40%. Variable cost per unit is 20 naira. Therefore, sales price per unit will be 50 naira. Now that we already know the selling price per unit, we've gotten variable cost per unit. Then contribution per unit will just be 50 naira minus 20 naira, which is what? 30 naira. Do you agree?
So I didn't get.
Okay. Which area is not clear? Do you get selling price per unit? 50 naira.
No, sir. Why are we dividing 20? 20 is a variable cost.
20 naira is the variable cost, right? Now, 20 naira, that 20 naira represents 40% of something. Are you with me? Don't worry, you will understand it now. 20 naira divided by 40% will give us 50 naira. Now, we are saying 20 naira represents 40% of something. In order to work back for you to understand what we've done, selling price is now 50 naira. 50 naira times 40%, what do you have? Are you with me?
Yes, sir. 20.
It's equals to 20, right?
Yes, sir.
That is our variable cost is now 20. You agree now?
Okay, the sales price. Yes, sir. Yes, sir. It's clear now.
Okay, that one is clear, right?
Yes, sir.
Now that is clear. So to get the contribution will just be selling price less variable cost.
To get 30 naira.
That's
Okay.
30, right?
Yes, sir.
Okay, thank you. Now that you've gotten to variable cost, what did they ask? What's the requirement? For current year, calculate the budgeted contribution per unit. You have done that already. Your budgeted contribution per unit is 30 naira. Abi?
Yes, sir.
Good. Then the second one, budgeted profit. Now that you have gotten budgeted contribution as 30 naira, you can just say, what is your fixed cost? We don't know yet. So, what is total contribution? If the budgeted contribution per unit is 30 naira, so 30 naira times 8 naira. Okay, no, let me not confuse you. I'm using that. Okay, yeah. Budgeted contribution is 30 naira times 8,000 units. What do you have?
240
240.
units.
Budgeted fixed cost. Budgeted fixed cost. This is the fixed cost per unit. So it will be 8,000 unit times 25 naira. You give us budgeted fixed cost, right? Budgeted fixed cost will be
Yes, sir.
8,000 times 25, that's 200,000. So 240 minus 200 will give us how much?
40,000.
That's contribution less fixed cost give us profit. Is it clear?
Okay. Yes, sir. Yes, sir. It's clear.
It's clear, right?
Yes, sir.
Great. Now let's go to next one. For next year, calculate the number of units that we have to be sold in order to achieve a total profit that is equal to budgeted profit in the current year. And they told us something that next year, selling price next year will be 6% higher. How much is selling price this year?
Selling price this year is 50 naira.
Okay. If it is 6% higher, how much will it be?
Be 53 naira.
Thank you. That's for selling price.
Yes, sir.
Okay. And variable cost per unit will be 5% higher than in current year. How much is variable cost per unit this year?
20 naira.
If you multiply it by, if you increase it by 5%, how much will it be?
21 naira.
21 naira, right? You know, you have gotten selling price 53
3
naira,
naira.
variable cost 21 naira. The difference will be contribution, right?
Yes, sir.
Okay. So how much is contribution now?
32 naira.
32 naira, good. Budgeted fixed cost next year will be 10% higher than budgeted fixed cost this year. And budgeted fixed cost this year is 27 naira, 25 naira. So next year will be how much? If you increase it by 10%.
27.5 naira.
Thank you. So just say 32 minus 27.5. What do you have?
4.5 naira.
4.5. Okay. So we just put that one somewhere. That's 4 naira 50 kobo. For next year, calculate the
Yes.
number of units that we have to be sold. The number of units that we have to be sold in order to achieve a profit that is equal to the budgeted profit in the current year. Okay, unit that we have to be sold. What is the target profit for this? What's the profit we made this year? 40,000, right?
40,000 naira. Yes, sir.
And that's our, what is our, and the formula for that is, this is it. This is the formula for what they asked us to do. total fees cost. So, what's the fees cost for this year now? For New Year,
The fixed cost for this year,
New Year. For next year rather.
fixed cost for the okay for the new year is 27.5 naira.
So 27 naira 50 kobo times
Yes,
8,000.
times
You know, it's
8,000.
no, unit is 8,000, right? So times 8,000. What do you have?
8,000. Give us 220,000 naira.
Thank you. 220,000 plus this year profit is 40,000, right?
Yes, sir.
Plus 40,000 divided by contribution for next year is how much? I think you just worked it as 32
Contribution is
for next
32
year.
naira.
32.
32
So
naira.
let's check their solution now. So this is it. You have gotten 32 already, Abby. This is 32 that you've gotten. So target profit next year is 40,000. Fixed cost next year is 220. Addition of the two is 260. So therefore, target sales next year is 260,000 naira divided by 32 naira. How much would that be? 260 divided by 32. What do you have?
8,125 naira.
So that marks the end of today's lecture. We'll continue with other illustration next week, Saturday. So it's time for questions.
So hopefully they're not going to be asking us to solve for all these stuff we do here.
They can, because it may form
Eh,
part of the question, yes. But it's
okay,
from, yeah, it may form part of your question. It may form part of the proposal because
all
it's
right,
part of your syllabus. It's in your syllabus.
okay, that's nice. All right, so thank you for your
But do you
time.
understand? Have you learned anything today?
Well, sure, I do.
All right. What of Amaka?
Sir, sir, I have a question.
Go ahead, please.
Concerning the ratios we calculated, right? Is it
Yeah.
like when a question is given to us, we are supposed to calculate all the ratios, starting from the profitability down to the investment ratio?
Thank you. Yes. But exams may exam may specify the type of ratio they want you to calculate. But in case they do not, you are expected to calculate as many ratio as information given to you in exam permits. You understand?
Yes, sir.
Information may not enable you to calculate investment ratio. It may not, you may not have information for other ratios. But you know we have 5 category of ratios, and those 5 category and their subdivision are expected to be calculated by you as many ratio as possible, but you are restricted to what information given to you in exam permits you to do.
Okay.
Any
So
other
another
question?
thing, where does this cost volume ratio analysis um come in the case study part or
Okay, it's
question?
part of your it may form part of the scenario based, it may form part of the proposal, so it may form part of the question they will give you. Because case study tests everything from foundation to skill to professional. It tests all the courses. So we don't know where they are coming from. We don't know how they are going to test it. That's why we have to leave no stone unturned. That's the reason why we are treating this.
Okay, sir. Okay, sir. Thank you,
Any
sir.
other question? You're welcome. Do you have any question, Mr. Abu?
No, I don't have any question.
All right. So thank you so much. See you same time next Sunday.
Thank you, sir.
Yes,
All right, thank you, sir.
next Saturday. All right. Thank you.